The FDIC chair just confessed your cash sitting in the bank, it's not safe. That confession, it wasn't leaked. It wasn't written in a whistleblower memo. But in an official filing with Congress with a title so deeply alarming, it sounds like the name of a doomed Jurassic Park sequel. The Deposit Insurance Fund Restoration Plan. The plan that suggests the safety net for your deposits needs restoring. You don't use that word, restoration, for something that's working. You use it for a dilapidated Victorian house with a raccoon infestation. And they didn't tell you about it, but they confessed to Congress. You've seen the sticker. Every bank in America has it. Little blue logo, FDIC insured. It's on the glass doors. It's on the homepage. It's on the back of the debit card sitting in your wallet right now. It's as comforting and ubiquitous as a wash your hands sign in a restaurant bathroom. And frankly, it ignores just as much fecal matter. The sticker means if the bank fails, your money's safe. Up to $250,000. Done. Sleep easy. You weren't wrong to trust it. The whole system is built so you do. And to be fair, it has never failed. But if you knew the math, you'd seriously wonder how long that streak is going to last. You see, for every $100 of insured deposits sitting in American banks, the FDIC Safety Fund holds $1.42. That's it. That's the airbag. That's the safety net. Imagine a head-on collision at 70 miles an hour, and instead of a protective balloon of compressed gas, your steering wheel just spits out a single damp McNugget. That's your protection. And that's not the bad number. That's the best it's been in years. The legal minimum written into federal law is $1.35. They just crossed back above the legal floor in the middle of last year, after being below it for 5 straight years. Now I'm going to go through 3 things with you. First, the math they don't show you. Second, what happened when a real bank actually failed, because we already watched it happen. And third, exactly what to do about it before the next one fails, because there are several on the brink. All right, so first, the math, because it's worse than you think. The FDIC has a fund. It's called the Deposit Insurance Fund, the DIF. That fund is what's supposed to cover your money if your bank goes under. It's not infinite. It's not the Federal Reserve. It's not the Treasury. It's a specific designated pile of money. As of December 31st, 2025, these are the freshest numbers that we've got, just released here in February. That fund holds $153.9 billion with a B. Remember that. Now that sounds like a lot, right? Until you hear how much it's supposed to insure. The insured deposits across the entire American banking system, roughly $10.8 trillion, with a T. The B is insuring the T. That's like Danny DeVito playing backup for Michael Jordan. If Mike blows out his Achilles in the finals, Danny's lacing him up as your new point guard. He's your guy now. You see, when you do the division, $153.9 billion divided by $10.8 trillion, the result is the technical term, the reserve ratio, 1.42%. The minimum requirement is 1.35%, and the ratio they're aiming for is 2%. So, get this, 1.42% requires a restoration plan. 2% is considered restored. So when somebody tells you FDIC insured, what they actually mean is there's $1.42 in the safety net for every $100 of your money. $1.42, that makes them uneasy, but they'd be okay with $2 for every $100. That's not a safety threshold. That's the minimum acceptable level of inadequacy. It is the financial equivalent of you must be this tall to ride sign, and the FDIC has been walking under it in clown shoes. And the only reason no major bank failure during that window cost you everything? Pure luck. And one weekend in March 2023, luck almost ran out. The federal government had to invent a brand new rule on the fly to keep the entire system from coming apart. So that weekend, March 10th, 2023, Friday morning, Silicon Valley Bank, SVB, $209 billion in assets, $175 billion in deposits. And if you're paying attention, red flag right there, because the entire FDIC safety fund is $153.9 billion. They're a little short. And this is just one bank. And it is too big for the safety net that's supposed to support every bank in the country. SVB is the 16th largest bank in the US, banked half of every venture-backed company in America. Solid, boring, the kind of bank that didn't make the news until it did. In 36 hours between Wednesday night and Friday morning, depositors yanked $42 billion out of the bank. The bank ran out of cash. The FDIC seized it Friday morning before the stock market even had a chance to put its pants on. Here's the part that matters for you. Of all the money sitting in SVB at the moment of failure, 93% of it was uninsured. That means 93% existed in accounts above and beyond the $250,000 cap. Businesses, payrolls, startup runway, university endowments, amounts the FDIC sticker did not cover. Per the legal definition, those depositors were creditors, meaning, and most people have no idea this is true, when you deposit money, you're not the customer, you're the lender. The bank is the borrower. It's always been that way. So when SVB went down, those depositors went to the back of the line with everybody else the bank owed money to, waiting for the carcass to get sold off, getting back whatever's left. Pennies on the dollar, sometimes years later. Meanwhile, the FDIC is supposed to make the insured depositors whole, up to $250,000 within a few business days. That's their job. That's the entire reason the agency exists. That's what the FDIC was supposed to do. Instead, over the weekend, the federal government invented a new rule. They called it the systemic risk exception. Sounds technical. Well, here's what it actually was. The Treasury, the Fed, and the FDIC sat in a room and decided that if the legal process ran its course, on Monday morning, the entire banking system would come apart by lunchtime. So they didn't follow the law. They wrote a new one over the weekend, made all of the depositors, the customers, whole, insured and uninsured. And here's the question they don't want you to ask. Where did the money come from? Not the FDIC. Their fund couldn't cover it. They didn't have enough. They didn't have enough for one bank. So they billed the other banks a special assessment. Every other bank in the country got a bill for SVB's mess, which means, pay attention, every other bank passed those costs on to you. Higher fees, lower interest on your savings, tighter credit. That's the difference between the bank's solvency and the fund's solvency. When both fail at the same time, somebody has to invent a rule on the fly. They yanked out your damp McNugget of an airbag and slipped in a real one and hoped nobody would notice. And none of what I just told you was a surprise to the FDIC. They didn't get caught off guard by SVB. They've been writing memos about this for half a decade. In September of 2020, the DIF reserve ratio fell below the legal floor of 1.35%. By federal law, the FDIC is required to do something about it. A month later, October 2020, the FDIC files that document with Congress, the Deposit Insurance Fund Restoration Plan. That document acknowledged that the safety net under your money was inadequate. They told Congress. They posted it on their website. It's still there. You can read it tonight. And they did it again and again. By federal law, they had to update it twice a year. Every 6 months for 5 years, the FDIC filed a new update telling Congress, still working on it. Don't worry about it. We got it. In May of 2025, Travis Hill, who is now the chairman, he was acting chairman at the time, gives a board meeting statement. And I'm reading directly from the published statement. Quote, I think we should consider whether insured deposits is the right metric to measure the DIF's exposure to losses. End quote. In plain English, the chairman of the agency that insures your money said, out loud, in public, on the record, that the way they measure whether your money is safe might not actually measure whether your money is safe. That's not a tweet, not a slip up. That's the chairman in a board meeting telling the country the math is wrong. Like it was an epiphany that $1.42 won't cover a $100 loss. You came to that conclusion inside of 60 seconds of this video. It took them years. And here's the part. He didn't get fired. He got promoted. Acting chairman to permanent chairman. Sworn in this past January. The system looked at 5 years of an inadequate fund, looked at the guy who was at the table the whole time and said, you're our guy. Here's the keys. Run the place. That is like promoting the iceberg that sank the Titanic to admiral. If you read his testimony, statements, and speeches, there is no urgency in any of it. There is no apology in any of it. There's a guy walking through the math of an inadequate safety net with the same energy you'd walk your dog in the park. Basically, he's okay with this. And the worst part is, you're supposed to be okay with it too. All right, so you know the math doesn't work. You know they've known. Well, here are 4 more things about the FDIC you should know too. Number 1, a few business days. This is the FDIC's payout promise. But your direct deposits, your auto pays, your mortgage, ACH, those don't pause for a few business days. The bank is gone, the bills aren't. 2, the financial advisor in your bank's lobby, same logo, but very different rules. The money market funds, the annuities, and bonds they sell you are not FDIC insured. If the bank fails, those products go with it. Number 3, the $250,000 cap is per ownership category, not per person. A married couple structured right can carry up to $2 million at a single bank if they want. For example, $250 in his single account, $250 in her single account, $500 in their joint account, $250 each, $250 in his revocable trust with her as the beneficiary, $250 in her revocable trust with him as the beneficiary, $250 in his IRA, $250 in her IRA. You get the picture. And you could keep going with self-directed 401ks, SEP IRAs, and in some instances at some banks, employee benefit plan accounts, government accounts, corporation partnership accounts. Now, it's probably not wise to do all of this at one bank, but you can if you wanted to. I mean, technically, you are insured up to $2 million in this example, but is it really protected? With the current reserve ratio at 1.42%, that $2 million is backed by just $28,400 in the FDIC's fund. That's like trading 4 Lamborghinis for a used Honda Civic. And that is the FDIC's secret plan to protect your cash. Now I'll leave it up to you if that helps you sleep at night or not. And number 4, that $153.9 billion fund, it's not all yours. The FDIC pays the cleanup crew first. Lawyers, receivers, litigation. The airbag can deflate quite a bit before it ever reaches your seat. You're essentially last in line. So let's get you out of that line. 3 things that you can do about it this week. None of them require a financial advisor. None of them require permission. Just 30 minutes and a calculator. Move number 1, use the FDIC's own calculator. They have a free public tool. It lives at edie.fdic.gov. EDIE stands for Electronic Deposit Insurance Estimator. Go enter your accounts, joint, individual, trust, business. The calculator will tell you exactly how much of your money is actually insured at each institution and how much is sitting outside the umbrella. I check mine twice a year, takes 10 minutes at the kitchen table. If the answer surprises you, and it surprises more people than you'd think, you've just identified your first move. You gotta move some money around. Move number 2, stack your ownership categories. This is the move most people don't know they have. A married couple with 1 individual account each, 1 joint account, and a properly structured living trust account can carry up to $1 million in FDIC coverage at a single bank, just like our example. And they can do that without moving a dollar to a different institution. Talk to an estate attorney for the trust piece. ProtectWhat'sMine.com are the people I used for my trust. The individual and joint moves, you can do that tomorrow morning. Move number 3, spread across institutions. If you have more cash than the stack can cover at one bank, split it up. Multiple banks, multiple relationships. And while you're doing that, most of the banks Americans use are paying near 0 on cash. That's a war chest sitting in a pothole. There are better FDIC insured banks to park your money. I posted the ones I'm currently using at stackmybanks.com. I think I'm averaging a hair over 4% interest right now. Active defense, 3 moves. None of this requires a course. None of this requires a $5,000 program from a guy recording a video in a rented Ferrari. This is a Saturday morning at the kitchen table with a cup of coffee and a calculator. Okay? So here's the decision to make. You can trust the sticker. The airbag is $1.42. The chairman has filed 5 years of restoration plans saying they ain't got enough in the fund, and he's okay with it. But the sticker says you're fine, so you can trust the sticker. Or you can take 30 minutes this Saturday, pull up EDIE, stack your categories, spread your liquidity. Stop being the person the FDIC is hoping won't read its own paperwork. And here's a different perspective. Did you know Warren Buffett's Berkshire Hathaway is sitting on more than twice as much cash as the federal agency whose entire job is to protect yours? That right there tells you everything you need to know. But here's what's not so obvious. Even if you do all of this, even if you stack perfectly, you spread perfectly, and you squeeze every dollar of protection out of your airbag, the FDIC isn't the only place where the safety net is thinner than the sticker says. And that's exactly why I pulled this video out right here for you to watch next. You know, Glenn Beck recently connected 6 different institutions, ones citizens rely on, that are experiencing severe turbulence. Well, I went through the video and I put a price tag on each one to show you what it looks like when consequences of the system's actions land on your front doorstep. Watch this next. God loves you, and so do I. Take care.